And now, please welcome to the stage Managing Director of HX Venture Fund, Sandy Guitar.
Thanks everybody again for being here, and I hope you had some good networking in the lunch break. Right now we're going to have a phenomenal conversation about the state of the market. Obviously very topical, and no one better to really speak to that, in my opinion, than the founder of LeadEdge Capital, joining us from LA and New York offices, Mitchell Green. LeadEdge is a $5 billion growth equity firm headquartered in New York and Southern California. They have built an incredible firm focusing on high-growth software, internet, and tech-enabled services globally. They've been around for over 12 years, welcome them to the stage now, with exits that include Alibaba, Spotify, Uber, Mindbody, Drilling Info, and many more. Names that, of course, when they first invested in them weren't as well known as they are today. You may recognize Mitchell as a frequent guest of CNBC Squawk Box, and we're really proud to say a very friendly guest for Venture Houston 2022. Also with us is Andrea Kors. So delighted to have Andrea, a venture principal at Shell Ventures, one of HX Venture Fund's limited partners. We are very proud to be working closely with Andrea and everybody at Shell Ventures to help them find kinds of technologies that might be disruptive to innovate Shell. Andrea's been a venture principal for Shell for the last 3.5 years, focusing on investments around robotics, artificial intelligence, machine learning, and growth stage companies that can accelerate the energy transition. Andrea's been in the energy industry for over 15 years and is passionate about climate change, gender balance, diversity, and is a huge support and cheerleader for HX Venture Fund, as well as many other ecosystem developers here in Houston. So without further ado, let me hand over to the two of them. Thank you.
All right, thank you.
Thank you.
Everyone.
I should have you write my bio.
Well, welcome everyone. And I know this is a hard spot right after lunch when everyone's feeling a little bit tired, but trust me, we'll get through this, and Mitchell is a great character, so you'll enjoy it. Before we get started, let me ask you, just to tell people here who don't know about LeadEdge Capital and about Mitchell Green, who you are and how you got to where you are.
Sure. So, tell you what LeadEdge is first. And if my goal is not to put you to sleep. When I started doing TV occasionally, the only reason I do TV is supposedly entrepreneurs think you're smart when you're on television, and so you maybe get calls earlier. But Stuart Varney from Fox told me, the guys at CNBC think they're investors. If they were investors, they'd be in your business. I am an entertainer. And so when I do these panels and stuff, I try to be light and funny and ask any what questions you want. So what is LeadEdge? So we're a growth equity fund. We have about $5 billion under management. We invest in software and internet companies around the world, primarily in North America. Probably about 70% of our capital is in that. We'll invest in companies anywhere from 10 to 15 million in revenue on the low end, all the way up to actually publicly traded companies as well. Part of our capital is in public investments, but it's really focused on software and internet companies. What makes us very different than almost any other fund on the planet is our investor base. We're very lucky to have a handful of awesome institutions like HX and Harvard and TRS and a handful of other great investors. But most of our capital comes actually from world-class executives and entrepreneurs. And if you were to look at our website under network, you could see these people. But it's people that have run and built some of the world's largest companies. And we've met all these people over the last decade or more through each other. And we leverage these people to help our companies grow. So whether that's with recruiting, maybe you're a $100 million revenue company and you're looking to hire an audit chair. So we can ask our LPs for suggestions. Maybe you're a software company that sells to pharmaceutical companies and you're trying to figure out how to get into Johnson & Johnson. Well, we have people that work there. Now, we can't obviously force companies to buy your product, but we can just help you get in the room with the decision maker. So that's at a high level. And how I got here, a lot of luck. hiring good people. Background, grew up in Grand Rapids, Michigan. Was a nationally ranked ski racer growing up. That was maybe 25 pounds ago. And went to Williams College solely, is a D3 school, but skis D1, and only way I got in there is because I could ski. And after there, I spent a year in investment banking, making PowerPoint presentations at 3 in the morning. And you never wondered why page 30 of the deck, why it had to be a red line in the middle, but like literally it was a completely useless job. Did that and then joined Bessemer Venture Partners. Bessemer is a world-class early-stage venture fund, and they had historically been very like Shark Tank-esque, and that 1,000 entrepreneurs would walk in the door every year, and they would back 10 of them. They got to know the folks well at Insight Venture Partners that had replicated what Summit and TA did, and that they would hire these 22 to 24-year-olds to pound the phones calling companies. I'm sure there's a bunch of entrepreneurs in the room. I'm sure you've gotten called by all these people. Put it this way, if the CEO calls you back, the company sucks. It's the CEO you call every 2 days for a month is who you like, that's the CEO you want to get to. So I did that for a few years. I left to go to Wharton Business School. After Wharton, I worked for a hedge fund seeded by Julian Robertson. And then in like 2009, 2008 timeframe, I spun out to create Lead Edge Capital. So that's how I got here.
Very good, thank you. So you're an expert in IPOs, right? Sandy just mentioned a few of the companies that Lead Edge has invested throughout the years. And we all know that the IPO window opens and shuts, depending on the certainty or uncertainty of the investors. And it seems like right now, the IPO market is the worst it's been since 1996, something like that. So what effect does that have for founders and venture capitalists? And what would be your advice for people, founders that are waiting to do these IPOs?
Yeah, so the IPO market is slow. I don't know if it's the slowest since right now it doesn't, IPOs, this is what, a company goes public to raise capital when the markets are volatile, the window shuts. When the markets become less volatile, they will reopen again. Your guess is as good as mine when that happens. If I was a betting man, I'd probably say first half of next year. You will start to see a bunch of IPOs. That being said, if you were and I'm talking software and internet companies, if you were a fast-growing energy company right now, given where commodity prices are, I'm sure you could go public. A delay in a closing of an IPO window causes venture investors or growth investors or private equity investors to not be able to get potential liquidity. Now, when you go public, you may not, in the IPO, be getting liquidity, but in the next 6 to 18 months after that, you'll be able to fully be liquid. That will just stretch out the time frame that you have to get, that your money is outstanding with your LPs or your investors in your own fund. And so, I think what it will really show, with a slowing IPO market, the biggest impact will be less distributions to LPs. That being said, LPs over the last few years have gotten a ton of capital back from a lot of funds.
So as a founder, other than wait for the right time, what else can you do?
As a founder looking to go public, you got to wait till the IPO markets are at the right place. Look, it also depends. For most founders of most companies, the IPO is still, you have to be a multiple $100 million revenue business, really. The last thing you want to do is be a $50 million revenue company and go public, because you kind of just get left in purgatory as a public company. You won't get any attention from big investors. And so for an investor who, say you run a $150 million revenue company and you were getting ready to go public. You just got to continue to operate your business like it is a public company, but you actually are still private. Now, hopefully you've raised a lot of capital, and most companies have, because of how much capital has been raised, in private companies. And so the reality is there's probably not, you're not doing, it's just business as usual right now, and you just have to execute. Now, look, you have employees that are oh, why didn't I thought I joined this company, I thought I was going to make a ton of money right away, we're going to have to wait longer. That being said, you're starting to see layoffs in tech and things like that. So like maybe some of the power is going to shift back to the employer. Who knows? But I think what you might see is in a year from now, so a bunch of companies raised money in like late 21, early 22, and they probably raised it for like 2 years of capital. And so, so they were okay through the end of December 2023. The problem is you're going to you might wake up next summer and be like, well, wait a second, I only have 6 months of cash left. And if the markets are actually stable, I think you might see a bunch of these later stage companies actually just go public. And the IPO actually might be a down round. It won't be in all cases, but I'll give you an example. Like Instacart, for instance. Instacart's a good business. Like I've never looked that closely at it, but it's a big business. I don't know if it's worth 40 billion, 20 billion, 10 billion, or 5 billion, but it's worth something. And just because the company goes public and the people who invested at 40 billion and it's now worth 8 billion, like okay, like investing's risky. But I think the worst thing for companies to do is actually raise like those big companies to raise like converts and things like that, because the early investors can just be like completely hosed. Employees can be hosed. When you go public, all your stock converts to common stock and everybody is on a equal playing field. So I think you will see a bunch of companies do that. And look, then it's just about executing. Square, which I'm sure everybody knows the sort of Square in here, Square went public. What you probably don't know is it was a down round. That's okay. And you bought the stock at the IPO, it's still, multiples of where it was. And so like, again, it's because they executed.
Okay. So let's switch gears a little bit and talk a little bit more about Houston, since we are in Venture Houston. Mm-hmm. We do have a significant Fortune 1000 base that is seeking to innovate by being customers to tech startups and even strategic exit opportunities, as was discussed in the previous panel. What role do you think that strategic investors will play going forward? And is corporate venture capital actually like the new thing? In your opinion, do you think that that's like venture capital is having a new day? What's your opinion on corporations? Of course, I'm biased. I think it works great, but I would love to hear your opinion.
Look, I haven't looked at the data, but I suspect that in 2020 and 2021, as a percent of capital, corporate venture capital went down. Probably because most corporate VCs have no interest in doing a deal in 3 days. In a lot of the growth, a lot of the market was driven by a lot of excess from some hedge funds, and that forced a lot of growth investors to move faster than they probably otherwise would have. That's reverting back to the mean now. And look, corporations have money. Profits are good. Now look, a bunch of people are worried about the economy and stuff like that. But like, look, in Houston, oil prices are like, are high right now. And so companies around here, I suspect, have a lot of cash. I would suspect over the next 18 months that corporate venture capital will be a higher percentage of the overall venture pool than it was in the past. And there's probably deals to be had for people. Like, give an example. If a company got funded in late 21 and had said they were going to do 20 million of revenue, going to 40 million, going to 80 million, so 20 in 21, 40 in 22, 80 in 23, going to probably like 140, and they paid a market clearing price. That deal, if they have to raise again next year and they hit those numbers, probably does an up round or at least a flat round. It's probably up given those numbers. Now, a lot of companies don't hit the numbers that they give to you. Imagine that. But they may have gone 20 million to 32 million to 48 million, going to 60. That's still awesome, but not if you paid thinking it was going to go to 140. So that being said, though, I think you might see a lot of corporate guys come in and start to do those types of deals and get into deals at some good prices.
So tech founders need venture capital to scale, right? How do we help Houston move from a flyover city to a destination for sophisticated venture capital? How do we attract investors such as yourself?
So, well, one thing, the state of California is doing a pretty good job scaring people away. So you just keep sitting here. Look, you have the model 200 miles north of here, however far north Austin is from here. And if you go and look at what appears to be in Austin, is it started really with Dell. And like Dell was there, and then Dell had a venture arm. People spun out of Dell. Dell created new companies. People move, it's just, look, we first made our first investment in Austin in 2008 in a company called Bizarre Voice. It just happened to be in Austin. It could have been in Houston too. But the founder had some like Dell roots. He also was originally from Austin. But I think that the tax policy and like the government policy of the state of Texas will continue to attract more and more people. What can companies do here? Well, look, I mean, the way to do it is, look, you probably have 10 companies in this town that employ some very large number of people. You need executives from those companies to be willing to go out and go meet big venture capital and growth equity funds around the country. So if they're in like New York City for meeting public investors, they need to take 2 of their meetings and go meet the big venture capital firms in New York. And that just gets people on the radar with them.
That's a good idea. All right. So speaking of venture funds, so HX Venture Fund, it's one of the funds that Shell is invested in, and they've invested in your fund. They have a powerful network of limited partners, right, which makes them unique. How do you leverage your network, and what else could be done to leverage that network?
Sure. So we leverage our LPs through basically the entire investment life cycle. And what do I mean by that? So, and we've used Sandy and Guillermo to do this. So like at the beginning, sourcing. I'll just tell you what we do, and then maybe some ideas will come out of this for people. So when we're trying to get in touch with a company in Houston that is not responding to our associates pounding the phones, and nobody leaves voicemails anymore, but sends them emails. And after like half dozen tries, we will then elevate it in what we call a hard to crack meeting, and we try to figure out like who we know that would know the company. So if it was a Houston-based company, we would just email our LPs in Houston, which is Guillermo and then a couple other people, and Sandy, and say, hey, does anybody know the company? If you have enough LPs in a city, you can pretty much like get into whoever, 8 or 9 out of 10 times, we will know somebody that knows the company. So that's like number one, sourcing. Number 2 is diligence. So maybe we're doing diligence on a software company that sells software, it sells restaurant point of sale system software. So we were like early investors in Toast. It was like 25 million of revenue, growing like 150% a year. And we had restaurant, it's like literally when the waitress or waiter swipes your credit card or enters the order, it's that whole like hardware plus payment system. It's next generation NCR or Micros would be Toast. Company went public. It's a $8-10 billion market cap company. We invested very early on. We asked our LPs, do you know people who own restaurants? Turns out that's a really dumb question to ask like 400 rich people because they all own restaurants. But like again, we were able to do diligence. We introduced Toast to a bunch of restaurants, and as a result, we got really interesting feedback. But more than that, it was a competitive deal process. Toast got customers, and so that's like pre-investment. Post-investment, we help with recruiting. So like Asana was looking for a female audit chair. Asana went public. It's a productivity collaboration software founded by the co-founder of Facebook. He was looking for a female audit chair. We emailed our LPs, and we got 50 suggestions on potential women. You don't need 50, you just need 1. And so we were able to find the one. Or maybe, this is probably one of the most common ways we use LPs, customers. So our maybe ABC company is looking to get introduced to somebody at like Dell or GE or Coke. We'll like email our LPs, or we just might know specific LPs that work at those companies, and you can't force them to buy your product, but you can like help them get to a decision maker. In any of these big companies, there's a huge amount of bureaucracy, and like if you can just help people get to a decision maker to help get to a decision, like we find that helps a lot.
Yeah, just navigate the system.
So navigate the system. So like what I would say here is, if you want to have VCs and big growth equity firms love Houston and companies in Houston, have executives from a bunch of these big companies go run around Silicon Valley, go talk to big VCs in Silicon Valley or elsewhere, and be like, listen, when you have really interesting companies that want to meet Shell, call us, and then help. Now you can't force them to get the product, but you could put them in the room with the decision maker.
That's true. So what are some of the go-to tech sectors that you are seeing right now as potential, investments? And then what are some of the bubbles that you think that should be avoided?
Well, avoiding. I'm a crypto bear, although I should have been a crypto bull because I got first told about Bitcoin about 10 years ago. No clue on it at all. I can't tell you if the right price of Bitcoin or Ethereum, or in the case of Bitcoin, is 60,000, 6,600, or 60. Your kids in high school and middle school might be able to, though. I just literally, it's not what we do. We're not currency traders. We tend to not invest. We tend to be software investors, so we tend to not be like really hard tech investors. But like I think hard tech is very real, and we'll be here, and people are going to build huge companies in it. There's a lot of ESG type investments that I think are a little bit of BS, but I think it is super important in these big energy companies. These big oil companies want to be energy companies so they can diversify their revenue streams. It's just smart given the price of oil goes like this, over like a 50-year period. But like, what do we like? So again, we're software investors. So vertical application software like a Toast, which makes it. Toast took a piece of hardware that would charge restaurants $20,000 systems to install. And they'd be like, and if you broke the system, you'd have to go pay $5,000 more to get it fixed or get a thing from. And by the way, the system looked like it was built in the 90s, from like just what the software looked like. These guys were like, no, let's build a computer system that's built on like commodity hardware. So if you break the hardware, you go down to Staples to get a new one at $100, $200. And let's build the software like it's a consumer software, even though it's built for enterprises. And then so now we got you tied into like restaurant software. Wait a second, we can do payment processing for you, and if we aggregate a bunch of restaurants together, we can get you better pricing on it than you could with like Chase Payment Tech or your payment processor. Oh, by the way, you use ADP and Paychex for payroll. We can get all our restaurants on payroll too. So using software to be like a operating system and different vertical applications to disrupt a bunch of commodity players. Like, what's the difference between one of 100 payroll vendors? What's the difference between one in 100 financial technology processing, credit card processing companies? Nothing. They're commodities. Security software is a big area of focus for us. My partner Avery has done some amazing investments there. The number of hacks in next year is going to be more than this year, which was exponentially bigger than 10 years ago. The problem is getting worse, not better. And so just like security software companies is a big vertical. This will be a couple.
So you mentioned blockchain. There's actually a question from the audience, from Patrick Riley, on blockchain investment, saying is the highest potential profit and also the highest risk sector. What criterion do you assess when looking at a completely new business?
So we have not spent much time looking at blockchain companies because most of them are very early stage companies. So we have these like 8 criteria that we use to evaluate a business. We take like a Moneyball approach to investing. We don't pontificate on sectors. We don't pontificate on investment themes. we have these like 8 criteria. And if you call 1,000 companies, you might find 5 to 10 that meet all 8 criteria. None of them will take our money, Sequoia's money, General Atlantic's money, KKR's money, or anybody's money, because they don't need it. And so you're trying to find companies that meet 5 of these 7 criteria. So like, what are they? Let's see if I can name some of them. Are you 10 million plus in revenue? i.e., do you have like product market fit? We help companies scale. We can't help them go 0 to 10. It's just not what we do. 2, are you growing 60+% a year? We're growth investors. When you look at the investments we make, they always look really expensive on today's numbers, but they look really cheap if the companies grow. 3, are they capital efficient? Warren Buffett would think this is the stupidest analysis for return on equity, but like it's our version of return on equity. Are your revenues today equal or greater than the amount of money you've burned since inception? Not raised, but like the world is littered with $25 million revenue companies that have burned $100 million to get there or $60 million to get there. Some of them might be good companies. Some of them could be incredible companies. They're just not efficient. Find me a business with 25 million of revenues that has burned less than 25 million to get there, or say 8 million to get there. That's an efficient business. Do you have high gross margins? At the end of the day, when you grow 10% a year, you trade off a multiple of earnings. Venture capitalists don't understand this, but it's true. When you're a public company growing 10%, you trade off earnings. I would much rather be Facebook than I would Albertsons or Dell. The reason is like at Dell, they have like 10% gross margins, and you have to pay for your soda or Coke in the like vending machine. Facebook, on the other hand, has 90% gross margins, and they give away iPads in the vending machine. Or like Apple, they print money. And so we want really high margin businesses. And then we have, we don't want customer concentration. Is it recurring revenue? Is it things like that? And we're trying to meet like 5 out of 7. So it's a Moneyball approach. And the blockchain companies don't meet any of the criteria because they don't have any revenues or anything like that. They're still like super early, yeah.
But you think in the future that might be something?
That's possible, for sure. Look, absolutely. In investing, the biggest, you only have time when you're an investor. And so like, we are like razor focused on only focusing on what we know and do it really, really well. The software ecosystem is really big. It's only getting bigger. We're still at the very early innings of what we think software is going to do to the world and make the world more productive and all these different things. And so like we're only focused on that.
Makes sense. So you mentioned what you look for in a prospective investment. How should an entrepreneur approach you? How do they find you?
Sure. Look, I was an entrepreneur, and I was a failed entrepreneur. I started a company in college and completely did everything wrong that you could do, especially knowing what we know now. My partners laughed at I can't believe you started that company. It sold to retailers, which is like the worst vertical ever to sell to, because don't sell to a sector where there's in secular decline. Start there. Sell to customers that have lots of money. That you can rate, selling to software companies that sell. We have software companies that sell into the biotech sector. They can double their prices, and their customers are don't care, have 98% gross margins. I would focus, if you're trying to start a company, focus on something that sells big market, and the customers themselves have lots and lots of money. How do you get in touch with us? I mean, it's easy, just email the hell out of us. But at the end of the day, look, we look at, my team speaks to 6,000 to 7,000 companies a year. And we invest in, and by the way, most of these companies have 10 million plus in revenues, and we invest in less than 10. But look, the great thing about America is it's like an amazing place to be an entrepreneur. And there is capital out there for all different types of stages of business. And the great thing is entrepreneurs and people who invest in entrepreneurs in America have made a whole lot of money over the last 10 to 12 years. And a lot of those people like to give back to entrepreneurs. And so the best advice I give to entrepreneurs is find the investor who's the match for your business, who like has invested in similar types of companies. Just other general advice. If you're a startup, people aren't going to sign an NDA. You look stupid making people looking like it. Now look, if if it's hard tech and it's like, Shell or Exxon could like completely like, there's like some patent that could be completely disrupted. But like, we are not going to go recreate your business because we know what you're doing.
I would say we wouldn't even.
You wouldn't do it either. It's like impossible.
We don't want you to send us an NDA, right?
Yeah. So like,
off the bat, like we don't want to look at your information. That's confidential.
We have signed it. Of course, we'll sign NDAs for bigger companies when we need to. But like, if as an entrepreneur, like starting on, if you've got a small business, it's just knowing. Do not tell if you are a company with 1 million of revenues. Do not put a slide presentation together that says in 8 years you're going to have $1 billion of revenues, because you are not going to. The probability that you are the next Google or Facebook or Alibaba Group or TikTok or ByteDance is like, or Snowflake Computing, is like you have as good a chance of winning the lottery. And it's nothing against you. It's the same thing as me picking that company. I just think it's like, walk people very like realistically through, how you're going to go from 1 million to 3 million to 6 million to 15 million to 30 million, like on this curve.
Very good.
And just be persistent. Don't give up. People ask like how we're successful. Like, I'm not that smart. Like, I've been told I'm not smart my entire life. My wife and kids tell me I'm not very smart still. I've never had more than a 3.3 in undergrad or in high school, but I'll outwork anybody. Like, literally, I flew in here at midnight last night. I'm here for this conference. I'm having dinner in Atlanta tonight. I've got a 7:30 a.m. meeting in LA tomorrow morning.
All right.
And I'm in New York on Wednesday. Work hard.
Please do submit your questions, all right? I can keep asking questions if you don't send me any. So we have to talk about the energy sector.
Sure.
Just because I'm biased.
Yeah.
But I'd love to hear your views on the energy sector and how you see climate tech investment and maybe ESG.
Sure.
No, you're not.
I'm not against it. Like,
I want to poke you and get.
No, it's fine. Look, I have invested in the energy sector. We were early investors, not as early as some people, but we invested in 2011 or 2012 with Insight Venture Partners into Drilling Info, which was basically the next generation version of IHS. It's like an upstream oil and gas energy data provider. We stupidly sold our stock up 4x. It's been sold twice since then, and I think each of the other investors has made 3 to 4 times their money. So that's what we've done in the energy space. And it was funny, when we first invested, the former chief principal financial officer, effectively CFO of Exxon, he's a long time LP in our fund. He's since retired, and he was retired then. He told me, we called him for diligence at help. This is like 2011, 2012 timeframe. We're like, what do you think of the product? He's like, I never heard of it. One simple question. Oil today is $100. When it goes to $30, tell me what happens to the company. Does it go bust? Because he's used to the energy sector where everything would blow up when energy prices tanked, and they would allocate when it was high and everything. And I'm like, no, it'll be fine. It's unlevered and it's like software. It recurs. He's like, oh, you'll be fine. He's like, and I'm like, but oil's not going back to 30. Yeah, it's done it twice along the way already. Look, I have to believe, at some point the U.S. government's going to wake up and realize that we should stop buying oil or maybe we should become a little less, dependent on the Russians, the Saudis, or the Venezuelans, or anybody else. Like, this country could appear to be, I know nothing about energy. It's just happening to talk and read stuff to people. It appears that this country could be energy independent if we would just invest the resources. And by the way, don't blame the energy companies, because I'm sorry, if I was a CFO of Exxon or Shell, I wouldn't want to go put $40 billion in Alaska, where 3 years later I might get my legs cut off. And so I want to ask these people that run the government, have you been to a lithium mine, or a lithium field? What's going to happen to all these old batteries? And so I think it's there's a huge amount of investment that will go into conservation and nuclear and other areas where we could just be better at it. I think a lot of this ESG stuff is important, but I think the first wave of climate tech, a lot of people lost a lot of money doing it, but people are going to build really big ESG software businesses, ESG compliance businesses, nuclear businesses. I would bet over the next 30 years you'll see a resurgence of like nuclear, for instance. But again, that's literally what I know about nuclear.
Okay, so I really want to hear a story about maybe a company that you didn't invest in, that you were like, man, we should have. Or
Snowflake?
What's that one?
Snowflake Computing. It's like one of the big, we passed on it at a $500 million valuation. It was like, I mean, we can talk all day about stuff I missed and mistakes and failures and things like that. But no, Snowflake Computing was a $500 million valuation. Bob Migliardi, the former CEO, who was the founder, but he's no longer there. We cold called the company. One of my guys had been on top of it. They were like, listen, we're raising like 50, 100 million bucks. Do you guys want in? It was like 20 million of revenue, had burned like 100 million to get there, had like negative gross margins. Oh, well, it's only 100 billion now, or something like that. It's like one of the fastest growing software companies in the world. And that company called MongoDB, we could have invested early in, I don't know, like Pinterest at 200 million. We're like, literally we met him. It was like 3 people in the garage. I mean, it was like 5 people in an office in Palo Alto. And our former boss had just invested. And I thought it was a really interesting product because it was growing really fast with people not on the coast. People that, if you find companies growing with like 100,000 people in San Francisco or like New York, those aren't like big companies. Those aren't going to be giant companies. But if you can find like the stay-at-home mom in Columbus, Ohio using the product, or like, you know, just random cities in America, and like the growth was just like out of control from these numbers. But it had no revenues, and we were like, no revenues? 200 million? Are you nuts? You know, it's not like a multi-billion-dollar company.
Understandable. All right. I don't see.
I mean, Facebook, who's going to sit at home and look at stupid TV? Who's going to sit at home and use their phone all day and look at like what their friends are doing, or like the people from like they haven't seen for 25 years in Facebook? Sorry, from high school. Then we're like, actually, and then we thought about it over the years and realized what we got wrong is like, it's just like watching television. Instead of watching, you know, if you think about in a given day, X amount of people, you know, in a given day, you sleep X amount, you work X amount, you eat X amount, you have time to do something else. That something else used to literally be like listen to the radio and watch TV. Now it's like watch Facebook.
Yep.
And the advertising dollars just moved accordingly. And then we also never realized so many people cared about what their like high school girlfriend from 25 years ago did. But turns out they do.
All right, we're starting to get some questions, and we only have a few minutes left, so I'm going to try to get some of these quickly. Should a profitable bootstrap startup with $1 to $5 million in revenue raise capital to grow and wait for higher revenues to minimize dilution? So I guess.
So let's pretend you have a $5 million bootstrap revenue software business. If you first, kudos to you. A lot of people love bootstrapping businesses. A lot of people love investing in bootstrap businesses. We love investing in them. It's actually what we tell entrepreneurs is the following. Don't take money unless the dilution outweighs the exit, the end of the day. Because right now, if you bootstrap your business, your employees probably own something, and you own the rest. Say you own 90% of it. Say you own 100% of it. Well, if you dilute yourself by 20% and raise capital, then the end exit, that 20%, better have been worth it. Another thing we tell entrepreneurs is maybe slightly more than 5 million of revenue, but maybe not necessarily, is listen, unless you have a rich uncle or aunt, or like, you know, you probably had like 99.9% of your net worth in this business. So sometimes it can be good to just take some secondary and sell some and not put the money on the balance sheet, but actually put it in your own pocket. Not because you're going to go out and live some extravagant lifestyle if you have $5 million now, which, by the way, the government will take, you know, 2.5, a little less in Texas. But, you know, that just gives you like comfort. And we find that if you give entrepreneurs a little bit of money for comfort, they actually make better decisions, because if people start running the business like thinking about what they're going to screw up, and that's like really bad.
Right, so we got lots of questions to get through. Cool. What is your thoughts on EVs, startups filing for SPACs.
Oh God.
And I don't want to get started on SPACs, but
So we have a SPAC. Yeah, like if I wanted to invest in companies with no revenues and lots of hopes and dreams, I could have 1,000. I could have 1,000,000 SPACs. I don't know. I wouldn't put $1 of my own money there. I have a lot of friends that made a lot of money shorting them. But like somebody's gonna build a big EV company. I have no clue. Like what do I know about batteries?
Yeah. So you love SPACs.
Yeah.
We all do.
But I don't blame the entrepreneurs for raising money. Like I did the same thing. But like I just think a lot of those are going to go to zero.
95%, I think, is this.
Probably 99.
95% of the SPACs that were filed last year actually did not meet their financial objectives.
Big surprise.
All right. What are the challenges you see with ESG? Could you expand on your earlier comment? What makes a good ESG versus a bad ESG company? You can pass.
The only thing I would say is look, this is like in general, find companies that meet real ROI. Like I just listened to Robert Smith, who's the founder of Vista, who's maybe built one of the greatest software investment platforms in the world over the last 20 years. A huge firm based up in Austin. They do software buyouts. He was basically talking about, and one of the things he said was like ROI. And that like they find like there's like their company's customers generate like a 600% ROI. He used a very specific number, which I found a little hard to believe. But like if you're gonna start a company, make sure there's like real ROI from a real potential customer. I think a lot of these like ESG companies are very like soft ROI, and it's very hard to prove. Why does that matter? Because at the end of the day, if you're gonna have a software business that's gonna recur in revenue, you want people to renew. My partner's got a good saying that I'm not thinking of exactly, but I'll kind of explain it, which is like you try it once, then you like buy it the second time because you really like it, or the third time. So it's all about like the recurring nature.
And what are your thoughts on the real estate sector?
I
Do you do anything in the real estate?
No, I mean the only thing I would say, like we've done real estate software in the software space. We have a company called Knock. Which makes like CRM, it's like Salesforce, but for like apartment buildings. I think you will see like there's a really good venture fund called Third Wall that specializes in just real estate, like prop tech. It's real. There's stuff out there. There's a huge amount of just like investing in energy, in tech for energy or tech for healthcare. It's a big sector. I have absolutely no clue what the price of real estate's going to do. I mean, it's inversely correlated to interest rates, but other than that, which are probably going up.
Yeah. So Brent Jans asks, has the market conditions led to LPs being more interested or less interested in investing in your fund?
That's a great question. So by dumb luck, we raised $2 billion before any of this happened. And here's what I'll pontificate in saying. So we set out to raise in our sixth fund $1.5 billion. And we set out to raise $1.5 billion, and we had about $2.5 billion of demand for the fund. And we ended up raising the hard cap of the fund to like 1.95, call it 2. Give the number. I think if we raised the fund today, we would have closed $1.5 billion and had like $1.6 billion to $1.7 billion of demand. That makes no sense, actually, because you actually want to invest in a recession. Like it sounds ridiculous because we have other portfolio companies, but we literally have nearly $2 billion of dry powder. We want a recession. Recessions are the best time to invest. They're also the best time to start a company. But yet investors, on the other hand, like you need to raise from when they think times are good, but all of them ask you, they're like, well, you're not going to invest now, times are too good. But then like, well, why don't you invest in the fund when times are bad? But they will never do that because they're all scared.
It's risk aversion.
Risk aversion, exactly.
Yeah, absolutely. This one's about your personal transition. So how did you go from working in investment banking to venture capital, and are soft or hard skills more necessary in this field?
Yeah, so I was an analyst, effectively a monkey at UBS in the investment banking group. In the investing, so when I started in bank, when I started in the field of tech investing, there were only a handful of firms that hired like 22 to 24-year-olds to do it. And now there's probably like 20 of these firms that hire young people to cold call. We actually, our associate program, which is 0 to 2 years out of school, we either hire people out of undergrad or we hire people with like 2 years of banking. And we've actually hired less people from like the Goldman Sachs's and Morgan Stanley's and like the big banks. And we actually prefer people that are like at smaller banks. We just find them like more gritty, like and like more resilient, and want to like run through walls and things like that.
Okay. What's your view on Web3?
I have no clue. Good luck. Like Bitcoin.
Okay. What about virtual and augmented reality? Do you see that as the future of marketing and business?
I describe it like at VR, AR as like self-driving cars. It will happen. It's gonna take a long time. I made a lot of bets with people in 2015 when I made my, it was 15 or 14 when I made our Uber investment. And people are like, in 2020, you're gonna be able to go from Santa Barbara where you live to LA in the back of a car with no driver. I'm like, okay, I can't get cell phone service at my house, so I'm not really sure how this is gonna work. Literally, same thing. Like a VR, AR world is probably real. By the way, put one of those headsets on for 20 minutes if you're over the age of 25, and you'll be dizzy by the time you take it off. But there's definitely like, it's gonna be like applications, for instance. Like I think telehealth is a giant like sector that's only gonna get bigger. Is there ways to use like AR, VR technology embedded in telehealth type stuff? Yeah, I'm sure there is.
Okay, 2 more questions. If IPOs are the next down round, as you mentioned, who will be the winners in software? Who should they invest their savings in?
Microsoft. I'm not kidding, actually. And we don't own it. Here's why. So I read a really interesting piece recently. It took all of these software companies and all these like companies and then divided like the price of the service divided by the amount of money that people in the field make. So like rough numbers. A Bloomberg terminal per year is like $25,000 a year. Doesn't matter if you're 2 guys running a hedge fund or Goldman Sachs, they all pay the same amount. The average person in that field makes like $350,000. So it's like 6 or 7% of somebody's salary gets paid to Bloomberg. The average knowledge worker or white collar worker makes $75,000. The average fee they pay to Microsoft is $250. It's like, it's like less than 1% or 0.2%. Microsoft could triple the prices in here and every person in this room would still use Microsoft Excel or Microsoft Outlook and like Word and like, look, I understand there are alternatives, but it's nowhere, not 6% or anywhere near it. Like Microsoft is as safe as a government bond.
All right, and in the last minute, Mitchell, if you don't mind, as you were a founder yourself, if you could give some advice to the founders in the audience based on your experience, what would that be?
Just like, I'm not very smart, just work hard. Like, it just sounds hard, but like, all I do is work. I've never had a vacation in my life. Of course I've had vacations. Like, my partners say I go on all vacations all the time, but like, I'm constantly working. I'll put it in a different way. So if you work at a hedge fund and you do it, you're a public markets investor because you do it because it's a job to get paid, you're competing with somebody who's thinking about stocks 24 hours a day while they sleep, eat, do everything. Do something that you're like passionate about and you can be successful in it. Like you just have to be passionate about what you're doing.
I would like to say don't work too much. Life is too short.
But I like it though. So like, for me it's fun. But like, just do what you want to do. Like, if I was retired, not working, my wife would be like, "You'd go nuts or kill yourself on your bicycle." So like, you just do something passionate and do it well.
Very good. Thank you.
Oh, thank you so much. Those are such great words to end on.
Thanks for having me.
And you heard it here first that the IPOs are the next down round, and we want a recession. So, you know, this is one of the many reasons I love Mitchell Green. He's going to say the things you didn't think you heard right. Like, did he just say that? Like, I think he did. So anyways, awesome. Thank you so much. And also, if there's any question about the role of corporate venture capital, then you just need to know Andrea Corus, because clearly corporate venture capital is doing fabulously well and is a big part of the change, both here in Houston and beyond. So thank you both very much.